Hello, ladies. This is the next in the instalment of CC8. This is PowerPoint 7. This is the case for government intervention in markets. So we're going to take a look at this together. This is starting on page 59 of your booklet. There is quite a considerable amount of information within the booklets which describe a little bit about state provision of public goods and the reasons for those things. If you actually have a read through pages 59 through to around about 67, I think it is, there is some extra information which will help you to understand these areas better too, in addition to what we're going to go through in the PowerPoint. So that's what we're going to take a look at then. So government intervention in markets is what we're going to be taking a look at. Just in the background, you might be able to hear there's some fireworks going off, so I might just shut the window to save that from distracting us too much. I think that's slightly better. So, case for government intervention then. Number of reasons why government intervention might take place. I'm going to move myself over here a bit, make it easier for you to see the content of the slides. Obviously, in this case, the non-rival nature of consumption provides a strong case for the government rather than the market to provide and pay for public goods. So remember, it's one of those key principles about how public goods are public goods, the fact that they are non-rival in terms of their consumption. Next point is that in some cases, some of the services that some of the public goods that are being provided pretty much free at point of use or point of purchase in inverted commas, then they generally need to be paid out of general taxation or another sort of fee like license fee, for instance. And the market may not necessarily choose to do that and provide it at a social optimum, and so as a result the government tend to do that to ensure that goods that should be provided are provided. Again, talking about this, it will help to prevent under provision and under consumption of public goods, so that effectively social welfare is improved. So the government, when it sees that the market is not actually providing a social optimum in terms of the way it's distributing goods or services, then that's where it will step in and provide some form of government assistance to make sure that happens. And obviously, in some cases, some of the public goods that we're talking about, due to the government having economies of scale and they can be more efficient in terms of the way in which they might operate and provide those goods or services. So if we take a look at the difference between public and public goods versus merit goods, then again, we can see that in this instance, one of the things that we sometimes need to bear in mind is that we sometimes make a bit of a mistake and to argue that all services provided by the government are public goods. Well, clearly they're not, and in some cases the public can't necessarily be excluded from consuming a particular good. But for instance, if we take a look at merit goods, they may well be provided by the government, and they're provided because they will generally have positive externalities and are likely to be under-provided by the free market, and so wouldn't necessarily be able to be afforded by all. And so again, looking back at some of the things we talked about, both negative and positive externalities, though that does have an effect on this whole process. So why are healthcare and education not examples of public goods then? So there are that's something to think about and suggest why that might be the case. Let's take a look at problems with government provision then. So in some instances, whilst we feel it might be a good thing for the government to provide some of these goods and services, there are in some cases a few issues around that. So, for instance, we talked about this in instance where the government may not necessarily have perfect information. and it may choose to over-provide or under-provide public goods on the basis of that imperfect information. So that's something that we also always have to bear in mind when it comes to the government choosing to provide some of these goods and services. It may well be that there are some political motives behind the government choosing to provide these public goods, and there may be a significant opportunity cost, but maybe the government of the time wants to make sure it gets back in power for next time round, and so in some cases it may well be that they will use vote winners rather than what is really most politic, if you like, for all of us to benefit from that particular decision making process. Another thing to bear in mind is that the government is a monopoly provider, and as we've talked about before in the last couple of booklets, a couple of booklets ago now actually, back in CC5, I think. The government is a monopoly provider in lots of scenarios, and so it may well be suffering from inefficiencies caused by being the only game in town, so to speak. Clearly, the other thing to bear in mind is that if public goods are provided free of charge, it may well be that there will be overuse if they're treated as free goods. So, for instance, roads as an example. So, if there's no charge at all, then that might be open to abuse. So, typical sort of question that you might get asked on this sort of subject matter, then. Evaluate the case for government provision of goods and services such as flood defence schemes or housing. That's a 25-mark question. Clearly, it would be useful to plan that, to give it some thought as to how you might go about answering that question. Remember command words in the question, making sure that you're answering the question, providing evaluative statements, and also trying to give a judgment as to whether you think it's a good idea, good use of resources, or a bad use of resources. And again, if you take a look in your booklets, there's some more assistance on that, particularly the Eddystone Lighthouse clip that you might like to take a look at on page 60. You might have to view that in a digital sense, the booklet there, to be able to click that link and take a look at it. So next thing then, the other thing to bear in mind when we're talking about the issues that the government might face, we mentioned imperfect information, and clearly in this instance, then remember we've done the example when we were looking at behavioural economics, where we were looking at lemons and in the second-hand car market, and the fact that in some cases, if you have more information than you're willing to share with your consumer, you're in a strong position to be able to influence their behaviour, and that may not necessarily be the most suitable way of allocating resources. So, if we're talking about imperfect information, then clearly we've talked about this quite a lot in the past. So, if we believe in the ability of the markets to effectively and efficiently allocate resources, it's very important that all of the economic agents involved in that activity, producers and consumers, have good information about the markets in order to make rational decisions. Now, clearly, if you've got all the information at your fingertips, you're likely to be able to make a more rational decision. But if you're not given all the info that you need to know, then in this instance, that might actually cause a poorly informed choice, and that might not necessarily lead to the best allocation of resources as a result. So we talked about information gaps, symmetric and asymmetric information, and how that can cause issues around the resources being allocated in an inefficient way. So let's take a look at information failure then, and how that might bring about negative externalities. So there is the standard view, the standard textbook view, is that all economic agents enjoyed perfect information about the availability of goods, how much it's going to cost them, so that they can make a rational purchasing decisions based on full information about the product. Well, we know in our slightly imperfect world that is not the case, is it? But clearly, one of the things that we would do again in the traditional theoretical approach is to draw a demand curve for an individual, assuming that we know how much utility they will gain from that particular product. Well, how do we do that? And is it an accurate assumption to make? Maybe not. Now, obviously, in some cases, we've got to bear in mind that the assumptions there are a number of assumptions caused by this process, and in some cases where information lets you down, or there is you're not making the decision based on all of the information at your fingertips, that clearly can cause a bit of an issue. So moving in and looking at how that happens then, sorts of things that can cause it if people have inaccurate or incomplete information, if they've misunderstood data, and as a result of that, they might make wrong decisions. Now, in some cases, there might be a vested interest in a seller actually providing information that's not very clear, so that they can maybe exploit the consumer's lack of understanding, and in some cases that clearly can be somewhat manufactured to make sure that the producer is actually benefiting more than the consumer in the transaction that's going on. Examples then. Clearly, in some cases, you might not necessarily know the true costs and benefits of a product. For instance, there might be uncertainty about the costs and benefits that you get. It could be very complex if you think about some of the financial services products that we have to get involved with when it comes to pensions and life insurance and Lord knows what else. Loads and loads of complex information, and very, very difficult to understand unless you've got a real clear understanding. And in some cases, that information failure is almost encouraged by the producer in order that they can maybe make more profit and benefit from maybe exploiting a lack of detailed information that the consumer might hold on a particular product or service purchase that they're making. In some cases, it can be misleading too, as we mentioned. And other instances, for instance, we might well have, if we're talking about products that are maybe addictive, like tobacco or alcohol, for instance, when clearly we're not told that that is the case, then that clearly creates its own set of information failures. So, thinking about that, then we talked about this principle, and what tends to happen is that if we get some sort of information failure, that's when all or some of the participants in the economic exchange don't have that perfect information. It could well be that we've got asymmetric information, i.e., one participant knows more about the economic exchange than the other, and that clearly is also a case of poor information being provided, and in some cases that's going to mean that decisions aren't necessarily going to be made on all of the facts. Now, that's clearly going to lead to a misallocation of scarce resources. In some cases, consumers might pay too much or too little, and the firms, as a result of that, might also either produce too much or too little. And that is a very common thing in lots and lots of transactions that will take place in your lifetime. There will be situations where you have not got the perfect information, or there has been some sort of information failure. And I'm sure you've probably experienced some of those already, and I'm sure you will experience quite a few more in the future. Okay, so symmetric and asymmetric information, then let's take a look at that in a little bit more detail. So if it's symmetrical information, the buyers and sellers have the same information about the costs and the benefits of the product. So that's essentially almost like a perfectly competitive market. Asymmetric is where, in this case, the seller has maybe more information than the buyer, and that's going to lead to some form of market failure. Some examples include warranties. So in some cases, you might get warranties missold. So high street retailers saying that you really should take out a warranty on this particular good on a TV or a dishwasher or whatever, and actually when it comes to claiming on that warranty, then it's absolutely useless, and yet you've been paying for it all the time that you've been financing the purchase of that particular product. Subprime mortgages, as an example, and we've talked quite a bit about that, and we'll talk about it more during year two when we start to look at some of the market failures that happened during the financial crash. And in this instance, a subprime mortgage, a lender doesn't really know how likely a borrower is to repay their loan. And also the lender, because they're maybe not an ideal candidate for a loan, or the borrower isn't an ideal candidate for the loan, may then charge extra over and above what they would charge a normal prime mortgage as opposed to subprime mortgage. And that clearly obviously causes some degradation in the information and also in the decision making process for the people thinking about taking out that subprime mortgage. Insurance. Car insurance companies can't always tell the risks associated with every single driver, so they will try and judge the risk. But to be honest, that's a very difficult process for them to appreciate, and they will have to take a bit of a view on that, and that in some cases can cause some issues. Market for used cars. We mentioned the market for lemons, didn't we? Used car seller knowing more about the quality of the car being sold than buyers do, and unless you're a mechanic and you can appreciate some of the issues that might happen with a second-hand car, it's a very difficult process to be able to assess what that is, what the problems are, and then make a completely rational decision, particularly if the seller is telling you, oh, it's a fantastic car and it's had no problems, blah, 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 blah. Okay, so some of the options to increase the supply of knowledge then, because clearly more information is going to be better than less information. So some of the things that we might be able to do are included here. I'm going to move myself over here again so it makes it easy for you to see. So one option, the government might actually force producers to provide accurate information about products through accurate labelling, for instance. It's becoming a bit of a hot topic to say the least. E numbers to indicate chemical additives in food and drink, and also making sure those labels are accurate and consistent so that you can compare one with another quite easily. Another thing, public service broadcasting. So improving knowledge, talking about smokers and drinkers and the true cost of their habit, for instance. In some cases, the government might choose to advertise on our public service TV, and radio broadcasting might even subsidise that in order that that information can be got out into the marketplace and out to the mass market via TV and radio channels. Could be laws passed, so government might choose to pass laws to force public companies to be more transparent, to publish their financial accounts, as well as to have them audited to ensure accuracy. Clearly, if we can see details of an organisation and they're making supernormal profits, then we might actually have a bit of an issue with that and think, well, actually, not sure whether we might be being exploited in this scenario, in that the business is being very successful and yet we don't seem to be getting any benefit back from them. Other things, employers might be forced to request that job applicants disclose information about themselves, so whether they've got a criminal record. Clearly that would be another way of improving the overall situation, so that we know we can base any decisions on a sound knowledge base. The government has the option to regulate advertising standards and does so through the ASA, the Advertising Standards Authority. That is a sort of quango within the advertising industry. But if you get a number of complaints about a particular advert, then that in some cases the ASA can either ban it or get the advertiser to change it in some shape or form to improve that situation. The government can also force car owners in this instance to have an MOT test after 3 years. So anybody that's got a car that's over 3 years old has to have the car tested to make sure it's still roadworthy. And obviously that's for two reasons really. One, it's to keep people safer on the road, and two, making sure that cars aren't going to break down and cause issues in terms of uh, the expensive issues that might cause, so accidents that might occur because cars are faulty, etc. And they will also, in some cases, in order to provide this extra knowledge base, um, and to increase the supply of knowledge, they might use regulators or watchdogs such as the Office of Fair Trading to comment on whether an organisation is trading in a fair way or whether they are flouting the rules. And obviously, if an organisation gets a bad reputation for doing that, then that's clearly going to cause, in some cases, people to not buy from those organisations. And so, again, it's something that can be used quite effectively to improve the knowledge that people have when they come to making decisions about products or services. Now, another thing that we need, a concept that we need to bear in mind, is something called moral hazard. Now, it's not a particularly complicated concept, but it's something that is often asked about, and this basically is where um, a moral hazard is where you've got no incentive to guard against risk when you're protected against it. A little bit like insurance, okay? So it tends to be um, when we're talking about an organisation that is maybe taking risks over and above what they should be doing, because they know that if they were to fail in some shape or form, then they know that in this case the government might step in and assist. For instance, so during the financial crash, that was an example. Or it was certainly considered to be quite a good example of moral hazard, where the financial services companies decided to go ahead and do stuff that was maybe a little bit risky, but because they knew that at the end of the day, the government would step in if they were to fail in some shape or form. So, to some degree, this is where a party is been insulated from risk, and then as a result of that, behaves differently. Rather than if they'd been exposed to the full risk of the decision, then they might have chosen a different pathway in terms of the decision making that they make. Okay, so in some cases it's because of this, the individual or the institution believes they're not going to have to bear the full consequences of their actions. They might choose to act less carefully, um, and they might then leave another party to bear some responsibility for the consequences of those actions. So the financial crisis is a classic example where the banks carried on in a slightly cavalier way, to say the least, and then it was down to the taxpayer through the government and the tax system to effectively bail some of those financial institutions out. And clearly, had that not been there as a safety valve for them, then they might have chosen to do things in a slightly different way. So, trying to bring it down to the sort of the basic principles, and the insurance business is quite a good example to use here. If an individual has insured against theft and been insured against theft, they might choose to be less vigilant about locking their cars, for instance, because the negative consequences of their car theft might be partially borne by the insurance company. Now, in this case, and there have been cases where if you have locked your car, or you can, or the insurance company finds out you haven't locked your car, then they might choose not to honour the claim. But in some instances, or in other instances, they will. The behaviour of the individual may not necessarily be quite as it should be, due to the fact that they've gone through the process of getting insured against certain things happening. So one could argue that this sort of relates back to a type of information asymmetry. So effectively, in this case, the banks, if we talk about the financial crisis, the banks knew more information than the consumers did. Okay, and in that sense, the banks were partially insulated, and are probably going to be more ready to take risks, and because they know they're not necessarily going to have to pay for the negative consequences of taking that risk. So that covers the that section quite efficiently there. So talking more about some asymmetric and symmetric information, but also some of the issues around government intervention in markets. It's quite an important concept to get your head around that one. And then if we take a look on page 63, there is a question which asks, and as a task set for you, which says, why might there be imperfect information in the following markets, and what might be the consequences and solutions? So again, trying to give you examples of the typical types of markets that you could use and refer to, whether it's healthcare, education, pensions, alcohol, tobacco, second-hand car market, and insurance. And then some of the reasons why there might be imperfect market information provided, and what some of the consequences and solutions might be as a result. So filling in that table, giving that a little bit of thought and a bit of time to fill that in would be time well spent, so that you've got good examples of how imperfect information might affect certain types of markets, and you can use those to help answer any essay questions that you might get asked on this particular subject. Okay, so thanks for listening once more, and we'll speak soon.